All right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas, and today we're going to be taking a look at ticker SNBR, sleep number. Give me one moment to share this out real quick. I think this company should be a pretty interesting one to take a look at. There's a lot that I like about it, though I do also have some criticisms as well. We'll get into some of that. I'm not entirely sure what my position on the company is as of this kind of moment, but either way, it was a very interesting company to do the numbers for. Getting into that, as we had kind of put together this list of companies that we're slowly working our way through. As I said, we're doing sleep number today. We'll be looking at Patrick Industries. It looks like as of probably our next one. Just kind of wanted to mention that. Not entirely sure. Let's see if there's anything interesting as far as some economic data that come out over the weekend. We did already go through a lot of these numbers right here. Consumer confidence numbers came out, also continuing downward. Not entirely unexpected with that. We're going to get consumer sentiment numbers tomorrow, and then our list is kind of up for that. So I'm not really sure about economic data moving into next week. It'll be interesting. So we'll get into sleep number. I did put together a pretty interesting revenue model for it. Trying to get too hung up on this right here. We're not entirely done with all the numbers yet, but this is somewhat of an estimation. I mean, like I said, I've already kind of worked through a lot of the numbers, but we can see what we think about it as I go through. Kind of starting from the general bottom. Oh, actually, I didn't realize I never fully filled this out. I knew it was going to be this number because it had been the same number as some of our previous groupings, but I'll actually have to go get the industrial grouping numbers for the retail special line group, because that is actually the industry that I was using it for, which is why I ended up just putting 1.09 in, because I knew that was exactly what the unlevered beta was, partially because we've done retail special line companies for literally like the last three valuations or so, because I just remembered that the 1.9, I couldn't remember off the top of my head what the margin and the sales capital ratio was, but those numbers weren't necessary to do the prep work. So kind of skipped right past that. Where is it? Yeah, okay, so 5.77% was the industrial average for them. Sales to capital ratio. Pull that up. Well, where is it? There it is. Okay, so 2.99 is what the industrial grouping was for that. It wasn't really necessary when I was preparing it, so I kind of forgot to come back and do that after the fact, but well. Anyway, so with that, industrial grouping 1.09 is the unlevered beta. Operations entirely in the United States, so an equity risk premium at its base of 4.24 after adjusting for the ratio of time frame since the year start, we end up with an equity risk premium of 5.23. Applying the debt to equity ratio of 40% to that, we end up with a levered beta after adjusting for the tax rate and the interest rate. We end up with 1.45 as their adjusted beta. Like this is a total risk premium of 7.59. Slapping that onto the 10-year interest rate, and we end up with a cost of equity of 10.42%. So pretty significant. And overall, their debt pile is not too bad. The interest rate they have is 6.1%. However, that actually gets cut down below 4% because of the tax rate interest effect that they have. But it is $409 million worth of debt, which is where they get the 40% debt to equity ratio at a weighted average maturity of 6 years. So pretty decent on the years level, but the interest rate is, it could be a little bit cheaper than that. I suppose you could say it's definitely not the cheapest debt in the world, but it is all lease liabilities. That's one thing that's worth noting about it. So with that, we can kind of take a look at the historical numbers. I do have 10 years worth of history that we can look at for them. You can start at the top with the share price. You can see that over the course of the 10 years, they've gone from $24, $25 per share up to $70, $80 per share at the end of 2020 and 2021. And then they've dropped down to $42 to $43 per share as where they currently stand. They've been buying back their stock pretty significantly over the last several years. A pretty decent amount in the first 5 years, but a real significant increase in the 5 years since then. You can see that with the year-over-year numbers of the share increases here. They do have a decent amount of RSUs and options, but not a crazy amount relative to the overall pile. So brings their current market cap, if you include those, up to about 1 billion currently. They've peaked in their market cap according to the year-end numbers here at about 2 billion. So you could say they're down 50% from their all-time highs in terms of market cap. Down a little bit more significantly from the all-time highs in share price because of the share buybacks that they've done during that time frame. So taking a look at the sales that they've had over the time frame from 2012, they had $935 million in sales, doing pretty significant growth each year: 2%, 20%, 5%, 8%, 10%, 6%, 10%, or 11%, 9%, 17 to 18%. So they had pretty consistent growth, but it was mostly in these single digits, except for this year with a 20% in 2014 and 2021 with a 17 to 18%. Huge growth. So even off of the back of some really difficult years like 2020 or 2021, they've done really, really well, though obviously they've been a beneficiary of large amounts of excess liquidity out in the overall financial system. So that's one thing that bounced back for that. But you would have expected that they might have had a little bit harder of the supply issues perhaps in one of these years. Maybe they would have done really good in one of them, but maybe not done so great in the other. But I guess you could argue maybe that this could have been a better year, so maybe that is part of the depression in this year right here. But either way, if you're looking at a rolling 5-year CAGR, you can see it's pretty consistently been in these strong upper single digits, only dipping into the double digits because of this particular outlier of a year. So either way, 8 to 9% seems like a pretty consistent way of thinking about their growth over the last 10 years. Think about the gross margins. You can see that it has moved up and down a little bit over the course of it, but it's definitely the trend is slightly downward. I'd say it's a little bit rough to say it's a downward trend, because obviously you can see 2020 was up at 62%, which is even closer to where they were at the start. But overall, I'd say yeah, it's a little bit of a downward trend. You can see the 5-year CAGR. Most of the time, it's been a slightly downward movement, slightly moving upward for a couple of these years, but overall, on average, it seems to be a slightly downward movement in gross margins, but still pretty strong gross margin. That's the thing I would note, that 60% is still pretty significant, especially for the type of manufacturing that they're involved in. I think that does go to show a decent amount of the brand power that they have. Now, their SG&A, this is not something I normally talk about in huge amounts, but it's something I'm trying to think about a little bit more in terms of like the scalability of business models, and thinking about how these costs move up over time relative to sales. And so thinking about that, you can see that the SG&A has grown pretty consistently over time. Nothing too drastically, but it's nothing. If you're looking at the 5-year CAGR on a rolling basis and comparing it to the sales growth, it's really kind of in line with that, though perhaps not always in the same years. They're mostly in these upper single digits, with 1 year dipping into the double digits. So that does seem to imply that the amount of sales that and general cost that is required to operate their business seems to expand at basically the same clip as the revenues, which is not exactly super great for long-term scalability. But to kind of balance back that criticism, I would say that you can also take a look at the R&D costs, which I do generally have a little bit more of an optimistic view on, considering I use an R&D capitalization method to adjust the profit expectations of a company. They've grown their R&D at a very impressive clip, much faster than the SG&A costs. In fact, they've grown it faster than revenues. Which on one level might seem like a dangerous thing to do, but if you consider this capital expenditures, then that really just becomes a primary form of the expansion of their business. So we'll think about that in terms of the overall capital expenditures further down the line. Either way, that does result in an operating margin that has decreased over time, as you can see from these upper single digits levels. Yeah, they had some lower ones in these other years here, but overall the average of these 5 years is definitely a little bit higher, 8.6% for the average of those 5 years versus an average of 7.5% for these back halves. So you can see the operating margins decrease over time. You can definitely blame that on the overall scaling of the SG&A, but also for the increase in R&D costs. So moving further down the line, we can see the the reported net income margin has basically the same effect as the operating margin, which is that it's a slight decrease over time. If we then include the R&D capitalization effect, as I was talking about, that gets us to a difference in the operating margin. We can only really think about the last 6 years or so because the R&D capitalization effect doesn't fully kick in for these years. If we're thinking about these 6 years at least, maybe we can see the 3-year average, see if there's a change over time. The average for these 3 years is 7.16 versus the average for these years is 9.38. So there is actually an increase in the operating margin over at least this 6-year period when you do an R&D capitalization on it. So the overall increase in their R&D has had a positive effect on their operating margin as a result. And so you can kind of do the same thing for the net income margin, 5.4% for the average of those 3 years and 7.36 for the average of these 3 years. So an overall increase in the profitability because of the fact that we include R&D as a form of capex that then gets amortized over time. The average corrected net income margin, by the way, is 6.38% for these 6 years, which are the years that we're going to think of as our appropriately measured profit margins, and that's relatively in line with the 5-year average, which is 6.57%, which is basically the baseline we're going to use as our net income moving forward. I'm also using the listed interest rate as our baseline effect for the valuation as well, because of the fact that the interest that they provide on here is not including all of the unaccreted and unamortized lease liabilities. So moving down to the cash flow statement, we can see that they do have a pretty significant amount of depreciation to balance out against the overall capital expenditures that they have. On net, we can see that in this line right here, there was some pretty positive capex in the first 5 years, and then that's kind of turned into some negative net capex in the back half of these 5 years. So showing that they've built up some facilities, but they haven't really needed to build up a lot of those physical facilities probably as much. And it's mostly just an expansion again of the sales and the R&D that keeps their business operating. So that they've been able to get capitalized on some of the depreciation effects on the profitability. But they do, however, have a pretty significant amounts of change in working capital effect on cash flow. So as they increase their working capital, that has a drain on their cash flow, and this is effectively another form of capital expending. So if we try to think about that, the overall effect on the cash flow for the first 5 years on average was slightly positive. It wasn't really a huge amount, but it was slightly positive. And then if you think about it for the back half of the years, it's actually turned into even more of a positive effect. So this is actually going to be decreasing their overall capital spending relative to everything else even more. So if you think about all these things in terms of it, the only part of their capital spending that becomes a major net positive ends up being the R&D expenses, as we talked about before, that we're going to include as part of the capital spending. So if you include all of those effects as part of the capital spending, the capex, the depreciation, the change in working capital effect on cash flows, as well as acquisitions, which we didn't really talk about, there's not really a lot there, but also then the R&D capitalization and its own amortization, I end up with this adjusted net capex line right here, which is basically one adjusted number to describe all of the capital spending that they do in their business. And you can see that for the first 5 years of our historical data, they had an average of 49 million per year in this figure. But it is a little bit backloaded because of the R&D capitalization effect. So let's try to maybe pay attention just to these these most recent 6 years, perhaps. And on average, it was negative 5 million for the back half of the 3 years, and then the forward portion, it's negative 40 million. So basically, they also are gaining in their cash flows as an effect over time because of the way that, yes, they're doing a large amount of R&D, and that's the major form of their capital spending, but a lot of the other forms of the capital spending that they did in the past, they're actually turning to more profitable measures, and that's partially where the excess cash flow is coming from down here. As you can see, the free cash flow equity, which is adjusted for the amounts of debt payments that they made in the back half of the 5 years, they had debt payments averaging or a positive inflow of debt of about 4 million per year on net, compared to the average of 27 million in cash flow to the shareholder. So they had pretty decent cash flow even before taking out that debt. And then the positive cash flow from the debt that they receive in the back 5 years is 79 million per year, which is a little bit more. And comparing that to the amount of cash flow that they received as equity shareholders of 221. So still pretty positive free cash flow before taking out the debt. But either way, they have been taking out debt in those years. And again, as we talked about at the start, the interest rate they have on that debt, and because it is essentially in the form of lease liabilities, is effectively 6%. So it's not exactly the cheapest form of debt. The reason why that's relevant to bring up is because they are doing a decent amount of share buybacks. If we look over the total common payout over the entire period, it's 152 million per year on average versus the average amount they could have paid out their shareholders of 124 million. So they've been overpaying their shareholders. If we kind of do it on the most recent 6 years, 157 million versus a payout of 182 million. So they did pretty good in those 3 years. Then 242 million in the most recent 3 years versus 256 million. So they've overpaid a little bit in the most recent 3 years, and then we're doing okay in the 3 years prior to that. So this is part of the reason I bring that up is because if they're overpaying their shareholders, that means they're effectively doing it through debt. And if they're doing it through debt, then they better be getting it at a cheap interest rate, an interest rate lower than the return that they can get on the share buybacks. The interest rate is not a very cheap interest rate, and some of the buybacks they did were also at some pretty elevated levels, as we talked about. However, the valuation still looks to be pretty good on them. I mean, we kind of already pointed that part out at the start a little bit. We'll get into some of the projections on that, see if maybe we can destroy it a little bit. But like I said, I've already put in a lot of the assumptions on here, so that number is already pretty good. So you could argue that this was a good move on the management's part. Actually, that totally reminds me, I meant to pull up in the executive compensation statement that I found, but I was looking into this, but this is particularly relevant because when they're doing so much share buybacks in here, and I was also looking through their presentation as well as their 10K, I noticed that they kept bringing up the returns on invested capital so much. And normally I love returns on invested capital. It's like one of the most important metrics that I like to pay attention to. But when a management brings it up so many times over and over and over again, I kind of have to wonder, what is the reasoning that they keep bringing this number up? Are they just as enamored with this really, really good number as I am? Or do they have some sort of ulterior motive? Since they were doing so many share buybacks, and I also knew that there was a decent amount of insider holdings on this company, a decent amount of shares held by the CEO and other board members, I was like, I got to look into the executive compensation statement, see how it is that they're paid. Are they being paid strictly on returns on invested capital? And the reason why this matters is because if you do huge amounts of share buybacks, you get rid of the book equity and turning it into an entirely debt finance company. And with a debt finance company, you end up with a huge amount of returns on invested capital, which is basically exactly the situation that they're in. So I was a little skeptical, kind of wondering if there was some funny business going on where they had their what's it called, their incentives misaligned from the shareholders to be able to properly manage the business. But I did come away deciding that wasn't necessarily the case. They actually do have an executive compensation system that is based off of more than just the returns of invested capital. It's based off of net sales and operating income increases, as well as overall share price increases, as well as the return on invested capital. So it does include those features. They just actually seem to really believe that that's a really good metric. And as I had said before, as long as you can argue that the return on investment for the shares that still exists is higher than the interest rate that's being paid, then you can argue that the overusage of the free cash flow to equity in the form of issuing more debt is okay in the short run. It isn't sustainable in the long run, so that's where things end up being still a little bit of a weird question. We do have to note that, for example, for the last 4 years, their shareholders' equity have been negative because of the fact that they have negative retained earnings as a result of doing a significant amount of these buybacks. Obviously, they've been very profitable through this entire period, so that's just the crux of it. Those same 4 years, they had done $509 million in profit, which was also turned into $978 million in equity cash flows, which was then paid out in over $1 billion in share buybacks. And so that's kind of, like I said, that's the point, is that they did $1 billion in share buybacks off of the back of $500 million in GAAP earnings, and the GAAP earnings is effectively what the retained earnings is tied to. So yeah, those are my criticisms on the cash flow. I still think the company is very, very interesting, and I'm very, very very tempted on it regardless of this feature. But it's something that I don't think this can be sustained going forward. I don't think that they can do quite the same level of buybacks, especially if interest rates are going to be moving up. And then it all comes down to what we think about their overall cash position. As you can see, the returns on invested capital are insanely high, and that's because they have this really good incentive to push to go to do so. So if we do take a look at their balance sheet and kind of get an idea of what we think about it, they obviously don't have a lot of cash on hand because they've been paying it out in the form of the share buybacks. Receivables, they have 25 million, 20 million kind of for the last several years on average. Compared to the payables, they have a way larger amount of payables. So they do have that concern. The overall current assets comes to between 150 to 200 million for the last few years on average. Comparing that to the amount of payables, much more, more like 650 million. So definitely it would only take like 1 year really of hunkering down and paying their bills to really get this the ship in order. But it's definitely a little bit of a basket case in terms of balance sheet. In fact, that's probably the one thing that really makes me not want to go for it. It's like, it looks like they're doing a decent amount of work on the overall cash flow aspect of it, but the management of their balance sheet makes them seem like they're at a higher level of risk than that number's in. And I'm not entirely even sure how to bring that into the valuation, other than to assume that maybe that somehow turns into lower margins as they have to pay back their bill payers. I don't know. We can look at that a little bit further as we move forward. But yeah, so I mean, as it said, the overall liabilities exploding upward from 148 million to 1.3 billion versus the total assets only 3xing during that time. So a 10xing in the liabilities versus a 3xing in the assets. A pretty significant amount of taking on of leverage. PE it's trading much cheaper now than it ever has in the past. Granted, that that change in the balance sheet state could definitely be argued as part of it, not just the overall growth coming down, but the overall state of risk in the stock being priced into the metrics. Obviously, it's already down from its highs pretty significantly. So the fact that it's still trading at such a cheap PE just goes to show exactly how untrustworthy the earnings are perceived, at least I guess in the short term. So if we do start to look at some of the numbers in more of the projection sense, we look at the sales to capital ratio over time. Extraordinarily high sales to capital ratio over the entire time frame. For the back half of the 5 years, it was an average of 6 versus an average of 5.86 for the more recent 5 years. Recent 3 years on average coming in just under 4. Hey GT, what's up? Welcome to stream. So that also partially has to do with the fact that they do have the negative shareholders equity. If you're going to have negative shareholders equity, obviously that's going to bring your capital base much lower relative to your revenue. And typically speaking, the market typically will adjust that over time, bringing your sales to capital ratio down back in line with the overall market by doing one of two things: either requiring you to take on a significant amount of capital, or requiring your sales to move on to different competitors. So what we think that is going to happen with that is kind of an uncertain metric. We have to think about different options. You could argue that it does need to maybe be reversed in the polarity of which we think is higher or lower. Yeah. Sleep Number is basically just a North American company as of right now. That could move on at some point in the future, but as of right now, it's operating basically just in the 50 states. They do have retailers pretty much throughout it, but only in so. But they do have a decent amount of direct channels for their own products, both online and the retail, that I think they're pretty well positioned that they probably could expand outside of America without too much difficulty. But they haven't talked about that, and there's also lots of extra risks that come with doing that type of strategy. So not necessarily for everybody to go for. I think you bring this down 2.5. I have to bring the margins a little bit lower, I think. Like I said, this is one of the things where I would assume that under normal conditions, I could probably assume that they're going to have about the margin that I have projected right here, 5.5 or so, as a pretty solid measure. But because of the fact that they have so much of negative shareholders equity, and a lot of that coming at the effect of large amounts of accounts payables that they don't have balanced out by large amounts of receivables, makes me think that they could end up having to lower the margin strictly on the fact that they have bill collectors demanding money from them at shorter terms. So I kind of have to handicap my margin assumptions for them based on that. Oops, not 11. Wrong number there. Handicap it about 1% or so. Brings it to 4.6. No, I never did actually get into my revenue models. So in their presentation, they talk about the size of the markets that they're going in. Actually, I think it was in their 10K in the business section that they had at these numbers, but they refer to a market research done by McKinsey, referring to the overall market for sleep health as about 26 billion, with it growing, according to McKinsey, at about 6% per year for the last last 5 years on average, with it being about 5% per year for the last 30 years on average. So I did two different forms of revenue models a little bit right here, and they have 8% of that market share accordingly. So 26 billion, 8% market share, that comes up to a revenue of 2 billion, 2 billion versus the actual revenues that they have of 2.1, 2.2 billion. So that math is, it's an approximation, but it sort of works out. So I did this little kind of model right here where I take the industry, I assume it grows at 6%, which is basically the same clip it's grown for the last 30 years approximately on average. That would make the industry grow to 34.8 billion or so. And then the worst case scenario, we assume that industry doesn't grow at all, which means it would stay at the 26 billion. Market share they have is 8%. Let's assume in the best case scenario, they get their market share up to 12%. They actually have been growing their market share over this entire 10-year period. So we're just assuming that stays in line for the best case scenario. Worst case scenario, let's assume their market share drops to 4%. It drops pretty significantly. So if we apply the 12 and 4% market shares to the market sizes we came up with, we end up with revenues of 4.1 billion in the best case scenario and 1 billion or so in the worst case scenario. So that's one revenue model thing that I kind of came up with. Here's a second one that I also came up with based off of historic data that they had come out with in their 10Ks. I came up with the average for 6 years. You can see right here, 2014 through 2019, partially because I wanted to have a 5-year CAGR. They have the stores that they had open during the period. I also have 2020 and 2021 separated off from 20. I wanted to do 2019 backwards because 2020 and 2021 are kind of weird years. So the 5-year CAGR ending in 2019, I have going on right here. Stores open during the period. Oops. Stores open during the period. You can see right here, it grew at an average of 5 to 6% per year compounded. The average store age in months went from 97 months in age to 94 in age, so it actually came down in age over the period, but only slightly. Average sales per store was 2.3 million, going up to 2.7 million or 2.8 million, which is 4.3% per year. The average square footage per store also increased 4% per year. The average sales per square foot also increased slightly, but just barely. So I did all these different metrics that they came up with, and then these bars right here are actually the correlations that these year-over-year numbers have with the sales growth. I wanted to figure out, which of these metrics actually make sense in determining what things make the sales grow. And the things I came up with that had the most positive correlations were the amount of stores that they open, as well as the average revenue per mattress unit. And then I also wanted to compare that with the most recent 2 years and see if these things had changed. Are these things in line with each other in ways that make sense? And the things that had the strongest correlations were the stores open during the period, as well as the average revenue per mattress. I decided to go with the stores open per period because I needed to be able to use other metrics to project with. The average revenue per mattress, they didn't give me other information that was going to make that as useful, and inflation has other effects on that. So with the stores open during the period, they grew them at about 6% per year for the 5 years prior to that. In the best case scenario, we'll assume that they grow their stores at 6 per year again, and that would bring them to 855 stores in 2026. In the worst case scenario, at 0% per year, that would bring them to 648 stores. We're going to use the average sales per store. Didn't have the highest correlations, but I need that in line with the amount of stores to be able to make an estimate. So I'm going to assume 4%, which is the same growth rate they had in the 5 year prior as the best case scenario, and 0% as the worst case. That gets me 3.5 million in the best case and 2.8 million in the worst case. If I multiply the sales per store times the amount of stores we have, that it ends up with 3 billion as the total revenue from stores in the best case scenario, and 1.8 billion as the worst case scenario. So now I've come up with two separate estimates of a best case and a worst case scenario. As you can see right here, I have the 4.1 billion, the 1 billion, the 3 billion, and the 1.8 billion. So I came up with four numbers. I kind of went ahead and just kind of tried to think about how to fit all four of those numbers into my projection here. You can see it goes up to 4 billion. In the best case scenario, it actually only goes down to 1.1, 1.2 because of some estimates on that. We can kind of maybe adjust that further down, see if we can get it down to 1 billion. And then the other numbers are kind of in the middle, but then I tried to adjust the probabilities to make them in line with that. You see 3 billion ends up right here. 1.5 billion is not quite the 1.8 billion, but we can kind of tilt the probabilities back a little bit towards it. So either way, this is how I came up with the revenue projections I came up with for Sleep Number. In the worst case scenario, I'm seeing them losing over 50% of their revenues off of the assumption that they essentially just lose a huge amount of their market cap. You know, people stop caring about having a special technological factor in their bed, and they just want to have a mattress because times are tough or something like that. You know, that's like the worst case scenario. Or somebody comes out and does their product basically the same way and commoditizes their whole thing. Best case scenario, they keep growing at basically the same rapid clip that they've been going for a while, and that gets them to 4 billion in 5 years. So on an expected basis, with the probabilities that I already have kind of assigned in here, that actually gives us an expected number of 2.3 billion, which I think is pretty reasonable. It's really only assuming a pretty low clip of growth. Oh, by the way, that does have to do with the assumption that I'm actually also using the 2-year average between 2021 and 2020 for my base year. And the reason why I'm doing that is that I'm assuming that in this next year, they actually do take a revenue hit. So our expected revenue for the very next year is only 2 billion versus their 2.1, 2.2. So we're assuming possibly about a 10% hit to revenue this year, and then that turns into an expected revenue in 2026 of 2.3 billion, which would come out to an expected revenue growth of 1 to 2% per year. So very kind of similar to some of the other projections we've done. We're assuming they take a hit in this most recent year, and then they come back to growth after that, and then that's the projections that we end up with. I will compare that with the analyst projections, for example, that they have on Yahoo. That they only have 6 analysts projecting for revenue numbers in 2022 and 2023. But either way, the expected revenue for 2022 on average is 2.3 billion. So everyone's still expecting them to grow this year, 7.5%. And the 2023 revenue growth expectation is 2.4 billion, so 4% there after that. So I'm projecting my revenue growth well below the analysts, and either way, we still end up with pretty solid numbers. But again, I did have to trim the margins a little bit, essentially on the assumption that they're probably going to have to pay their bills back at some point. But and the market very well might punish them when that happens, because that means they're going to have to stop doing share buybacks in the short run to do so. Unless of course they're just so profitable that they can keep doing that. But that really does depend on whether or not this slowdown in this next year or so happens or not. That's definitely a major factor. It's like, I don't know if they manage to grow through this year the way the analysts are projecting, and next year, on the back of basically a lot of other similar industry products having a little bit of a hit this year, then that would be pretty amazing. But I am definitely trying to think a little bit more conservatively in that. So double checking a few last minute things. Like I said, our interest rates are already set. Tax rate that's going into our discount rate at 18%. I feel pretty confident with that. You might say, oh, well, that feels like a low interest rate. Well, this interest rate is just about the tax rate. It's not, or just about the discount rate. It's not about the margin. The margin I assign independently of this tax rate. So we're already assuming a tax rate implicitly by assuming the margin here. This tax rate is just about calculating the discount rate, which means if you actually increase the tax rate, it actually makes the valuation go up because you're giving them an excess tax benefit. But since they're using lease liabilities primarily as their form of debt, I don't really want to give them that benefit. Not too much. They might take out more bond debt the next time they issue debt, so they can get that debt that benefit if they wanted to. But as it currently stands, that's basically not where it is. Let me think. Any other? Oh, this needs to be readjusted. I didn't even realize that this was so thrown off. Here, hold on. 5. What does that bring the expected to? 3.98. Okay, so that's about right. Okay, so we do need to adjust for the default risk. That's generally the last thing we always do here. Taking a look at the perpetual debt levels that we're kind of assuming for them, they're basically going to always have a bunch of debt. So we're not going to be able to assume that they pay it down. Lease debt, not necessarily. I mean, it could come from a bank, but that's different than like a credit line. A lease liabilities is like leasing a property. Like if they have retail stores, they may not own the retail stores. They might just be leasing them from somebody else. But so a lease it's just like a rental lease. But you can have operating leases, you can have finance leases. Sometimes you're leasing your machinery, sometimes you're leasing the buildings. You can lease all sorts of things, but that's effectively what it is. But that is essentially a form of debt because you're contractually obligated to make payments on a regular basis, and if you don't make those payments, you're going to go into bankruptcy. So it is effectively a form of debt. And so when I'm talking about lease liabilities, I'm talking about maybe their retail buildings, maybe machinery that they use to make the mattresses. I'm not sure what it is that they're leasing exactly, but it can be a variety of things like that. But so yeah, I'm not talking about a bank loan per se, but technically the bank could be providing this lease. So it's possible that it came from a bank, but it's not like a revolving credit line. It's not like a revolving credit line, if that's what you're thinking. Well, you pay that debt forever if you keep rolling it over. If you when you enter into a lease contract, like say it's a building. Let's just assume it's a building, and you make a contract with a building to operate your business there for 5 years, and you're to keep paying them rent every month for 5 years. At the end of the 5 years, you might continue to live there, you might continue to operate your business there, but you're gonna have to sign a new contract. And that's the same thing as rolling over your debt in the debt markets. You might put out a bond that has has a payment maturity in 5 years, and well, maybe you're not going to actually pay off your debt in 5 years. You might just issue a new bond instead, right? So it's the same thing. You see, it's like a lease liability. Any contractual obligation that will put you into bankruptcy if you do not pay it is debt. Like that's effectively the same thing in finance terms as debt. So that's one of the things that you have to do. Is you have to make sure, like you might notice, like and for example, like they show you these things on you look on Yahoo Finance, you can see, look at the financials in here. Let's go to the balance sheet. Yeah, I mean that's one of the options. I mean, some people prefer their people to own the property, but if you own the property, then that's an asset that has a value, and then that means that there's a risk that the value goes away, right? So like, what if commercial real estate in your area takes a huge hit, and now the value of retail corners suddenly plummets because that city's like just becoming less popular or whatever, and all the new town over the way is now the one that's growing. So the point is like a business that operates in an area, they can just get out of that lease, and then they can just go lease a new building and move their building much more easier. So just like it's just like a renter versus a mortgager, right? Like a person who has a mortgage, they get the benefit of having the property, but they also are tied to the location, right? So, but a renter can, if better opportunities exist for them in a different city, a renter can just go rent to a different area. So yeah, so businesses basically have the same option. That's basically all I'm trying to say. Sometimes it's great to have the property. Sometimes it's great to lease the property. Leasing means you do have these contractual payments you're gonna have to make. So it ties you financially down, but it doesn't tie you physically down. It definitely just depends on the company. There's definitely not, it's not to say like one's better than the other. It's just something you have to keep in mind. But like I was saying, like you can look at on Yahoo Finance, they'll show you basically what I mean. Like you can see right here, capital lease obligations in the balance sheet, total debt $791 million. But the actual that debt is mostly these capital lease obligations of 408 million that they list right here. So like Yahoo Finance will even knows this. They'll show it right there. It's kind of like a hidden form of debt. But yeah, it can be good, it can be bad. It's just a form of debt that retailers use this a lot. Retailers ever since Walmart came around, and especially Amazon since then, retailers have looked for newer and newer ways to essentially stream down the amount of capital expending they have to do. And so if you don't own the building, you don't have to make the capital spending. You know, that's just it's one of the things you have to do, but it also means you don't get the upside of owning the property. So yeah, it's just it's a balancing act of opportunities. So either way, we can kind of take a look at the valuation that we end up with. Oh wait, I didn't finish the defaults. Let's finish the part. Finish this. See what they look like. Yeah, basically. Although of course there's other stipulations to that as well. It's a contract. So if they have to hold to the contract, whatever that is, but there might be stipulations of that. So if they have a 3-year contract to stay somewhere, then they have to stay there for 3 years. Otherwise, they have to pay whatever fees there are for breaking the contract, which sometimes that's an option. But the point is so the person who owns the property may not have to stay there for the same time. They could leave markets too, but the point is then they would have to sell the property. It just changes. It's kind of like, it's just liquidity. It just affects essentially how liquid their position is in that specific market. So it's pretty interesting. Okay, so Sleep Number, ticker SNBR. Mature market risk premiums I have currently 5.23% compared to the US Treasury selling for 2.8% or so. I have a discount rate for Sleep Number of 10.42% after adjusting for the company's specific risks. They do not pay a dividend. 5 years ago, they had sales of $1.3 billion, and in the most recent year, they had sales of $2.1 billion. That gave them sales growth of 10 to 11% for the last 5 years on average. The sales capital ratio they've had for the last 3 years on average has been 3.9%, or 3.9, and then that compared to the industrial grouping they have of 2.99 is pretty strong, stronger than their industrial grouping. But again, we talked about how that partially has to do with their negative shareholders' equity, which has other complications and could affect their margins moving forward, which we did adjust for. Our returns on invested capital for the last 3 years on average has been 18.91%. That's an adjusted return on invested capital that I use adjusting for the fact that they have their negative shareholders equity. So if somebody else tries to calculate, they might actually find that the number's higher than that, but I kind of trim it down based off of the fact that I assume the shareholders equity effectively has to come back to at least a positive number in the long run. Debt to equity ratio I have for them is currently 40%, and the debt risk that they have in the most recent year is about 1% off of that debt. The profit margins for the last 3 to 5 years on average has been 6.5% compared to the industrial expectations for retail special lines of 5.7%. So overall pretty strong on both the sales to capital ratio and profit margin basis for overall a pretty low margin business. In general, their retail special lines don't have high margins, so being able to push anything above their industrial grouping is, while also maintaining good capital expense, is really good. They're currently selling for $42.80. The probability distribution that we're using is pretty heavily weighed into the median model, but we are tilted a little bit towards optimistic again, partially because of how we ranged our revenue projections. The sales expectations I have for the company, it goes from 1 billion to 4 billion. On expected basis, we see 2.3 billion for the 2026 numbers. Yeah, no, I'm always happy to get into that stuff. I will be happy to explain that part after I finish doing the overview. That gets us a sales growth expectation of negative 13% per year in the worst case scenario to possibly positive 13% in the best case scenario. On expected basis, we see a little under 2% per year. Sales capital ratio, we have a pretty wide range. On expected basis, we're seeing 3.98%. That also partially has to do with the negative shareholders equity. Returns on invested capital, we see about 18.5% or so on an expected basis, which is pretty roughly in line with the adjusted number that we currently have. So we're pretty confident and satisfied with those expectations. The debt to equity ratio, we have a pretty wide range as well, getting us an expectation of about 52%. So we're assuming they're taking on a little bit more debt in order to handle these issues. We assume that it'll probably be them taking on bond debt effectively to be able to pay off their other bills, which is in the accounts payables. We do see them having a pretty decently increased default risk because of this, bringing it to a little over 2% per year, which is pretty significant amount of risk. Anything more than 1% is pretty significant in my opinion, generally. But overall, it's still pretty decent opportunity regardless. Profit margins, we have a distribution of anywhere from 1% to 7%, pretty wide range. That gets us an expectation of 4.6% or so. And that gets us a profit distribution of anywhere from 11 million in the 5-year forward period to possibly 285 million. On an expected basis, we see about $110 million. That gets us a present value after you're adjusting using the discount rate that we came up with of $53.81, which is 25 to 26% higher than the current share price. We have 5-year forward value targets unadjusted for any dividends that they could pay out during the period of anywhere from $5.54 per share in the worst case scenario, possibly $221.74 in the best case scenario. On an expected basis, we see $88.32 per share, which if we compare that to the current share price of $42.80 per share, gets us an implied return of 15.59% per year for the next 5 years. So that's a pretty good return, over 15%. That's pretty satisfying. Short-term pricing metrics are definitely implying a pretty high return, although the next question is, actually it is pulling in an EPS expectation number for that. So I guess it's just coming off the back of the negative shareholders equity and the really low multiples. So this can probably also be ignored, but in general, I'd never really paid too much attention to this anyway. This is just an interesting way of looking at the pricing metrics of multiples. Really all about this the cash flow return. 15% and 16% per year, pretty solid. If we weigh in some qualitative factors like the sales capital ratio, returns on invested capital, and the profit margins, in the value score that I came up with myself, it gets me a value score of 1.08, which is generally pretty good. Anything over 1 is generally pretty good. I think it's like 1.15. That's like one standard deviation above my my sample set of value scores. So that does put them in line with pretty high good opportunities, about as good of opportunities as some other companies I've bought recently, in fact. So definitely very tempting company. I am uncertain about whether or not I want to buy them though, which has to do with some of the stuff that you were asking about. So we'll get back into that. I'll explain it again. Negative shareholders equity. They have negative shareholders equity effectively because they're doing too many buybacks. That's the main reason why. They have pretty good profit for the last 10 years. And on the back of that profit, they have even better cash flow than the profitability because they have done a lot of their capital expenditures way back in the past. And so now moving forward, they have really strong cash flows. But even so, they've done more buybacks than they've had available for cash flow. You can see that the average shareholder cash flow to equity that they had for the first 5 years of our historic group was about 27 million per share. And that was on the back of issuing about 4 million per share in debt. Not a huge amount of debt, right? It's only a tiny amount, 27 million in cash flow, 4 million in debt. So it's really about 23 that they could have paid out to their shareholders without issuing any debt whatsoever. But during the period, the amount of cash flow that they did pay out to their shareholders was 66 million per share to the shareholders. And so then the later 5 years, the trend kind of continues. They had $221 million per share, $221 million per year that they could pay out to the shareholders, and 79 million of that came from debt. So they actually had about 220 million that they could have paid out without issuing debt, and the amount of share buybacks that they did was 238 million per year. So, gosh, I wish this thing would go away. And I need to like get rid of that thing, honestly, from my Windows programming. But anyway, so the point is they've done too many buybacks relative to the amount of cash flow that they had, relative to the amount of debt that they issued. Now, it's not inherently too much. It's only too much if you can't continue to do it moving forward. It's not bad to do share buybacks if you're undervalued, and by the way, they are undervalued. So you can argue that at least it's a good return on investment for the company, because anytime the company buys its own shares, it's going to get the same return that the shareholders get. So if the shareholders get 15 to 16% per year, then that means if the company buys its stock at the current share price, it's going to get 15 to 16% per year, assuming all my numbers are right. So there's nothing necessarily bad about doing share buybacks. Even more buyback, even issuing debt to do the buybacks, as long as it's a good investment for your shareholders. However, you have to be able to make it to the years in which you do actually get those returns. And the reason why this matters is because it puts you at risk of default. So when you do share buybacks, when you add profit to a company, let's start with that first. Actually, when you have a good year and you add profit to the company, it increases the amount of assets you have relative to the liabilities you have, which means it increases the shareholders' equity. So as you collect profit over time, your shareholders' equity should increase over time as the retained earnings increases over time. And then when you do a share buyback, it does sort of the opposite move. It essentially eats out a chunk of your equity, because you're essentially taking some of that equity and paying it to the shareholder who's buying out of the company. So whenever you do a share buyback, it's a negative against the shareholder's equity, and the shareholder's equity is essentially a collection of all the profit of the company has made. So whenever a shareholder's equity is negative, it means that there is effectively been more profit paid out than profit collected, is what's happened. And so right now they have negative shareholders equity of 424, negative 425 million. That means, effectively speaking, they've paid out 425 million more in buybacks than their assets are technically worth currently. That's what their assets are worth currently. It's not necessarily a problem, because we know that they're going to earn a whole bunch of profit in the future. And so that's why it's like, it doesn't mean that they don't stop operating as a business. It's not the same as like bankruptcy. It's not like a bank is going to look at this and say, "Oh, you have negative shareholders equity. Now we're going to liquidate your company because you screwed up." But it does put you a little bit at risk of it, because you do have to earn that future profit in order to fix this problem. So it's kind of like they're borrowing against the future to do share buybacks. That's let's put it that way. That's actually probably the one sentence explanation, is they're borrowing against their future earnings in order to do the share buybacks, and something that you can't really do forever. And then I'll show you where you can see the source of this. You can see here, accounts receivable is the bills that it's revenues that you've collected, but people haven't sent you the money yet. You've sent people a bill, but they haven't sent you the cash yet. So that's what accounts receivables are, and that's an asset. The opposite of that is the accounts payable, which is that you have received a service or a product from somebody, but you haven't paid the bill yet to somebody. They have way more accounts payables than they do accounts receivables. So 25 or $26 million worth of bills are owed to them from other people, but they owe $238 million in bills, or $236 million, my bad, in bills to other people. So they owe some people some bills, and they haven't paid them yet. They also owe some people some debt, mostly just like I said, the lease liability debt, effectively. But they also don't have a bunch of cash on hand, which is effectively like the opposite of having the cash on hand, having debt. So they just have they have some debts and they have some bills, and they haven't paid them yet, but they have given shareholders their money back instead. And so that's what the negative shareholders equity of it is. But yeah, it does when you have negative shareholders equity, it artificially expands your return on invested capital, because if your shareholders equity goes negative, it effectively decreases that capital base even more. But so when I say I'm doing the adjusted number, effectively what I'm doing is I'm making it so that when I make the calculation of return on invested capital, I make it so that the equity can actually go below zero. I just say that the equity is zero if it's less than zero. And effectively that makes the number smaller than it appears. Still really high. I mean, it's worth noting 18 to 19% return on invested capital is still a really high return on invested capital. So they're still doing really good, regardless of that adjustment. But that's what the point of that adjustment is. It's basically saying, hey, okay, well, you have negative shareholders equity, but at some point or another, it has to come back to zero. At some point, it has to go back to positive, because you can't have more liabilities than your assets forever. Otherwise, what are you doing? You know, it's like the only reason people allow you to have more liabilities than assets is because they assume you're going to make money in the future. Which it looks like Sleep Number is. So yeah, so that's the good explanation there. Always happily explain things. Gives me more time to kind of ramble about things. So as I had said at the start of the stream, they did report that I don't think I included it in the notes I put up in here. They had it in one of their things. Did I? Maybe I did. Maybe I didn't. Hold on, maybe I can find it real quick. Give me half a second. Actually, maybe I can find it in the 10K faster. That might be easier. I think it was relatively high, though. I don't think it was... But again, it's okay if you buy back at a high level, as long as the value is higher. Equity, share purchases. Purchased. Where's the amounts? Where's the dollar? Miss it. Total dollar amounts, weighted average. The stock option grant. I saw it in here at some point. I'm not 100% sure. I don't really want to dig forever in it, but I'm pretty sure like over the last 2 years, I mean, they were near some pretty high levels. I mean, their stock was at pretty high levels, so I'm pretty sure it was pretty high. You can see like the year ended at 78, and the year before that ended at 82, and the year before that ended at 48. So you know, they were buying back heavy during this time frame right here. You know, so they were, but the value we get is 52. It's gonna go to 80 in 5 years. You could argue that they were overpaying it in some of these high peak levels. 78, 82. Yeah, so they were probably overpaying it for the last 2 years. Yeah, so that's definitely one thing that definitely doesn't attract me to the business. Like I said, it's like I think there's really high returns to be had here, but I'm not so sure. And since, like I said, I kind of bumped them 1% on their margin for that, but you could argue that it might be a little bit harsher of an impact, because that's something that they're gonna have to deal with one way or another eventually. But yeah, so I mean, actually, I didn't even realize that, because I honestly kept forgetting that they had peaked so high. For some reason in my mind, I keep telling myself that they had only peaked at like 100 or something, but I keep forgetting they peaked honestly that high. So that's so high up there. Yeah, so I mean, I guess they were overpaying a decent bit in 2020. Looks like 2021, yeah, also still pretty bad. anything that they've done this year looks like it might have been okay, but they probably shouldn't have been doing it these 2 years. They probably can't afford to do it this year. That's the thing. It's like they're probably going to have to slow down on the share buybacks one way or the other. So yeah, interesting company. Despite the fact that it has the good opportunities on it, I probably will pass on it, I think. But at least for now, maybe if it drops a decent bit lower, maybe it'll become a little bit more appealing. So looking forward, thinking about what we're gonna do on Monday, I'm looking at PATK as the next option. That was another one that came up on the screenings that we had done together, Patrick Industries. Another one that looks like it's kind of in that same vein of industries, a lot of kind of consumer cyclical, retail special line stuff, but this one's a little bit of a different vein. Manufacturers, distributes building products and materials for recreational vehicle, marine, and manufactured housing industrial markets. So I thought it was a little bit of an interesting mixture because it has some building product type stuff while also being a little bit of like a discretionary spending kind of recreational vehicle type thing. I thought that was a little bit interesting. It does have mixed markets between the United States, China, and Canada. I'll have to see what the proportions on that were. But it was a company that was coming up, like I said, dude. It was coming out through the screening that we were doing. So I was partially just interested in it, partially off of the back of trying to find out about new companies in general. But has a dividend. It looks like it's actually going to be reporting today. That's pretty interesting. PE ratio 6 to 7. It does have analyst projection of growth in this year, but it looks like they're expecting it to be turned back in the year after that. So pretty interesting on that front. I can't remember. Did they have a good insider or shorting? 6% on short or float, nothing too major, but a decent chunk there. 6% insider ownership as well. I'd have to see what insiders they are and for like what reasons and stuff like that. But yeah, so this is the one I think I'm going to be looking at next. But yeah, thanks for joining us today, guys. If you watched it up to this point, we'd really appreciate it if you could like the stream. The only way we're gonna grow this channel is by getting as many likes and views as possible. I really appreciate people who've been showing up, people who've been liking the stream. But I can definitely use some more. Just dropped on earnings, picked a small position. Oh, PATK, is that one of the ones that you have? Very. Was this one that you had recommended? I thought this was maybe one of the recommendations, but I couldn't remember. Thank you very much, guys. I see those likes coming in. Very appreciated. Either way, like I said, I'm definitely gonna end the stream here. I'll see you all again on Monday for PATK.